I don't think inflation is well and truly dead until you see some pain across, and I don't mean everybody, there's pain across the economy. I get that. But some pain at the macro level in terms of the employment and wage figures. So, I hope the Fed doesn't take their foot off the brake too soon, because my expectation is if they do, then inflation will roar back on this, unless you see some demand destruction through job losses.
It is now my great pleasure to introduce Andy Constan from Damn Spring Macro, former Bridgewater and Brevan Howard, to name a few hedge funds that you have worked for. It's a great pleasure to have such an experienced risk taker with us. Very good to see you, Andy.
Andreas, it's a pleasure to meet you finally. We've communicated a lot over the year, and looking forward to this time.
Me too. Andy, you've obviously been around for a while. So let's start by adding a bit of context to this year's sort of make or break kind of financial environment. Is this some of the most crazy markets that you have ever participated in?
Well, it's certainly unusual in that I think this is the worst bond market since, I saw something since 1778. That's a long time. So a big sell-off in the bond market is definitely new for every investor, including myself. I was still a teenager and an adolescent in the 80s and early 70s. So I missed all that. But, since 86, when I started, it's been pretty much a one-way train of easy monetary policy. And that's really the big shift.
It certainly is. Let's take a look at that bond market for a second. I think that's really an interesting driver of everything right now. What are some of your key takeaways when you look at portfolio construction in an environment of rising interest rates relative to what we've experienced over the past 2-3 decades?
Well, I think it's very important to distinguish between rising interest rates and monetary tightness. So this is a period in which monetary tightness is the driver, regardless of the level of interest rates. In environments where interest rates are rising, you can actually have extremely good equity performance because the interest rates are rising because there's lots of opportunity for investment in growth and growth assets. In this case, interest rates are rising for two reasons. One, inflation, which is something we haven't seen in a long, long time. And two, monetary tightness. And so that combination of things is very difficult for basically any asset. And you've seen that in pretty much any long-only portfolio returns over the past year.
Certainly so. Andy, I wanted to bring up the most recent rally in equities. I find it really interesting that we've seen such a big rally. I've personally been caught completely wrong-footed by it, to just admit it to the audience up front. So if we look at the current rally in equities relative to the rally that we had in the late summer, what are some of the differences and similarities that you've sort of noted when you've watched price action?
Sure. So in June 29th, I wrote a piece on what I expected for the summer, and then followed it up on July 17th with something I called the false dawn. And the false dawn was ultimately I correctly predicted a pan asset rally that was led by equities, but in really where every asset rally, bonds, stocks, gold, commodities, everything went up. And so until very, very recently, the rally this time, which, I had the good fortune of calling on September 29th, saying to go max long, and caught the bottom because of some very technical things that were happening in options expiration, but also because the circumstances were very similar to the false dawn 1. And so I called it false dawn 2. What hadn't happened until the end of October was really any other assets performing. Equities were up, I thought we'd get to 3,900 by October 31st, and we were pretty bang on that. But the rest of the false dawn assets, stocks, bonds, nominal bonds, tips, gold, commodities, pretty much didn't participate. A percentage up or down either way for each of those assets. And so it was much more narrow. I, like many, thought that the false dawn would end for a technical reason in my case, but also because of the Fed statement on soon after. And so got short equities at around 39.20, 39.25, which, has looked pretty bad for the last couple of days. As what's interesting is now the false dawn rally assets that lagged have really picked up. Government bonds have massively rallied in the last week, all on this CPI number. So I think it's possible we're in a different situation than we were at the end of the false dawn one, but I'm not ready yet to make that call. I'm still short equities, and I intend to hold shorts through year end. But all the pressures that happened in the June rally were here in September, and now all of the factors that, except for a couple of low CPI numbers, all of the factors that made me want to call a top ahead of Jackson Hole are here now.
One thing that we can add to this discussion is the outlook on bond issuance. You've been pretty vocal in some of your reports that we will actually see a slow but sure grind towards a slowing bond issuance from the US Treasury. Is this something that adds into your mix when you assess the current rally relative to the one from the summer?
Right. So I think that the trigger that said to me, and this I actually got modestly wrong when the data was announced, the trigger that got me short equities was the quarterly refunding announcement, which happened on August 1st and again on Halloween this year. In both cases, the importance of that report is it says how much borrowing the Treasury is going to make in the next year, the quarter that we're in, and then the following quarter. In both cases, it was much more than people expected, much more than I expected. In fact, over $500 billion, I got to get this right, $500 billion of new issuance was projected in Q4 and Q1. And that is really the transmission mechanism for quantitative tightening. Essentially, the money that is being raised funds a deficit, but also is needed to pay back the Fed for their runoff. And so I think that quantitative tightening's impact is going to be very, very strong in the next 2 quarters, which makes me want to be bearish all U.S. assets, but then it gets more tricky to think whether you want to be short more bonds or more stocks, or long bonds and short stocks, or what the right mix of those positions are, because this headwind is going to hit all assets, just as it has all year. But what relative performance happens depends more on the outlook for inflation and the economy.
Hi, I'm Raoul Pal, the CEO and co-founder of Releveraging. The financial world is a complicated world right now. It's a really complicated macro picture, and there's a lot of risks. Real Vision and our YouTube channel help you navigate those risks. So subscribe now to the channel and never miss an update. There is simply too much going on. So subscribe now. Thank you.
Yeah, and we'll get back to inflation in just a second, because I wanted to pick your brain on risk premiums across assets in the current rally relative to the rally that we had in the late summer. One of the sort of key gauges for most professional investors is the relative earnings yield implicitly between bonds and equities. How do you view that relative pricing of equities versus bonds right now?
All else being equal, measured with no change in the outlook for growth and inflation, but just looking at pricing, equities are richer than they were a year ago at the peak. It could be a legitimate thing if earnings were going to grow at a more rapid rate than predicted, than expected. You have to believe that to believe equities are going to outperform bonds in the near term. I don't believe that. I think equities are going to underperform bonds in the near term, and that's because I think that what's priced in terms of earnings expectations and future earnings growth is too high. But as a matter of risk premium, the risk premium is much lower than it was a year ago, which means, which is odd given the pressures on risk premiums due to quantitative tightening, which would tend to expand risk premiums. So it's a very odd mix of pricing in equities versus bonds and in an absolute space at this stage.
It's a really interesting discussion, this one on risk premiums, and we will get back to your sort of thinking on how to construct a portfolio given risk premium assessments.
Sure.
But if we look at the current rally, you already mentioned it, the elephant in the room, the monthly CPI report. We obviously got that huge rally after the most recent inflation report showing that the US economy is probably disinflating by now. But how do you gauge this inflation discussion into year end? Is it a discussion that you take part in? How do you assess it in your portfolio construction?
I don't generally try to predict prints, so to speak. I do look at sort of the pressures that are influencing the path of inflation more so than any one particular guess. There are people that do that very well. Some of them have real alpha. But I don't do that. I'm looking at the pressures, and my view on the pressures is that inflation won't be well and truly killed until jobs, either some sort of financial breakage occurs where either a provider of leverage or a large industry is taken out, and jobs are cut after the breakage, or jobs need to come down because the consumer, though they're spending quite a lot and levering up some of their credit card debt, they are doing that because they expect to be employed. You don't lever up your credit card always because you're about to go bankrupt. Sometimes you do it because you expect to get a bonus or you expect to keep your job. And so you just want to spend ahead of that. And so the demand side, true demand destruction, is only going to happen if we see consumers being forced to retrench. And that happens when the job market turns. And so I don't think inflation is well and truly dead until you see some pain across, and I don't mean everybody, there's pain across the economy. I get that. But some pain at the macro level in terms of the employment and wage figures. I hope the Fed doesn't take their foot off the brake too soon, because my expectation is if they do, then inflation will roar back on this unless you see some demand destruction through job losses.
So what's your base case on the Federal Reserve right now? Are they going to strike back against what we've seen recently in asset markets, or will they allow it to unfold? What's your takeaway from the recent communication from the Federal Reserve?
Yeah. There's some internecine differences of outlook that have been part of the Fed rhetoric since I've started watching it. And this time is the same. Brainerd was dovish, and it really depends on Powell and all those sort of things. My basic picture is what is consistent with what Powell said, which is the threat is inflation, and we're not experiencing any pain. So why not persist? That doesn't mean 75 in December. That doesn't mean a terminal rate of 4.5 or 4 3/4 or 5. It just means persist. And so for me, I expect the Fed to persist until inflation is well and truly dead, and that's going to be months from now. And so I'm on board with the current pricing. It's a little rich right now, but on board with the current pricing of something like 125 basis points between now and when they pause for an extended period of time.
That's one of the next questions that we're going to ask to the Fed? Because one thing is obviously to pause, but as soon as you pause, at least seen in history, the market is starting to chase a potential pivot into a cutting cycle, right? What do you make of that discussion into next year, a pause rather than a full pivot?
Right. So I have no expectation of a full pivot. I see no reason to do that whatsoever. And I'm also considering politics, which is, easing, pivoting in before the election cycle even gets started serves no political pressure agenda. So I don't think the administration is going to be putting pressure on the Fed until they actually see some pain that might be politically difficult. And we'll see about that. But, that's my outlook on that. But I think the most important thing to recognize is that the transmission mechanism for rate hikes in the U.S. is very different than it was decades ago, and very different than it is in versus other countries. Rate hikes affect consumption because they may make cash look attractive relative to using it and spending it for goods. But they also make leverage more expensive. But the U.S. Homeowner, the marginal homeowner that has to relocate is faced with high mortgage rates. But the holders of mortgages on existing homes, they're flush. They have interest rates that are, less than 3% in some cases. And those aren't going up for 30 years. So that transmission mechanism in the U.S. is just difficult. And so you have to use the wealth effect. That's your only other lever. And that means that negative reinforcement whenever asset prices go up. And we've seen both equities and bonds, but in particular bonds, gold, other assets, all spike since the Fed. And that's not what they want. Regardless of your opinion of the divisiveness within the Fed, none of them want an asset rally. So I expect they'll correct that at some point in time, unless the numbers just magically fall. And I don't think they can magically fall without jobs magically falling.
Makes a ton of sense, Andy. In relation to that discussion, I wanted your take on the sort of difference between monetary tightness via interest rate hikes and monetary tightness via balance sheet contractions. You've been writing about potential interesting timings in markets around QT ramp-ups. So let's get your take on QT as a driver of assets relative to interest rate hikes.
Right. So I think QT works through the wealth effect by making by generating additional supply that the private sector needs to absorb. And for them to absorb it, they have to reduce the price so that they are willing to, they have a higher expected return and are willing to lever up their positions, take on more risk. And so to the extent, and the flow around QT depends on how much issuance is happening, which, as we said, is now rising unexpectedly in Q2 and Q4 and Q1. And so there's more supply. And so that mechanism, I think, is a strong headwind. But there's also this idea that asset prices that are high are more vulnerable to the headwind than asset prices that are perceived to be cheap broadly. And so, I think the headwind blows heaviest against these assets as they rally, sort of like the proverbial Fed put is a support mechanism for assets. We're now in a world in which QT is a Fed call, which they've sold, which caps the market. And so we're going to be running into that cap. Is it, 4,300, 4,100, 3,900? Well, certainly we've gotten through that. And does it affect bond yields? Sure, it will. But it does it through the risk premium channel, which is, it just makes holding assets require a higher return because there's this constant supply of new assets being offered to the private sector.
If we look at your false dawn thesis, you had it spot on during the late summer, and now you're trying to call it a false dawn 2.0 this time around again. What are some of the key assessments that make you certain that this is a false dawn 2.0 in asset markets?
Right. So the headwind of QT represents the strongest offsetting force to asset rallies. And the other thing is positioning of institutions. And so in both the end of the quarter in September and the end of the quarter in June, my measurements of portfolio delevering reached extremes. And so we've had this great delevering where people just simply didn't want to own any asset of any sort and shrunk their book, along with, higher volatility driving, and larger drawdowns. And each of those things required, traditional institutions who may vol target, who may use portfolio insurance to shrink their size. And obviously somebody had to buy what they sold. And so those people that did really demanded a lot of price concession before they levered up. And so that reached a peak of delevering at the end of these two quarters. And the biggest flow that we've seen from remember, QT got stronger during this whole period, from zero in May to something quite significant now. So that was always a headwind against a false dawn. But the relevering flow, the animal spirits to buy assets when they start going up, was the principal driver for the rally, in my opinion. It wasn't anything about any macroeconomics. There's a lot of people that talk about pivoting and whether the Fed is going to stop. That was more, to me, part of the narrative than the actual flow. The actual flow was people had really delevered and they had over-delevered. And when you over-delever, you have to relever as markets rally. And so that's been the principal driver. And you see that most explicitly in this rally in the CTA performance. You've seen the biggest drawdowns they've taken in years in the last week. And that's because they had momentum sold bonds primarily as their key trade for the year. And that momentum massively reversed in the last few days, resulting in losses in that space and resulting in position flattening, which is, extended the false dawn more than I expected, given the rally we had in October. And the headwind blowing again strong. So I think it peters out at some point in time and the headwind does its job. But which asset to pick continues to be a question.
If you look at positioning today, which measures do you use to assess whether this releveraging period is over and whether releveraging is at levels that make it attractive to go short again?
So the number one thing I use is I have spent enough time with clients of Salomon Brothers and the way they think about managing their portfolio risk, myself as a positioner, and in particular at my role at Bridgewater, which included managing their portfolio construction activities. And so I know with a fair degree of clarity what institutions use to determine the sizing of their portfolio, the leverage of their portfolio. And what I've built is something that says today, what would they be, how delevered would they be, or how levered would they be? And then I have some momentum gauges of that sort of thing to determine whether there's some absolute numbers, interestingly, in that thing, in which you sort of know what the maximum delevering that the market is willing to do, how much cash it will really take on before it stops. So there's both a barrier that you may hit in terms of deleveraging or releveraging, and then there's a momentum of those things. And with that, I have a model which has, which is predictive of where we stand in delevering. And then I triangulate that with actual position data of, a broad range of homogeneous investor cohorts, and look at did they, over the years, have they followed this model? And if, and that supports that the model is a useful model in terms of where we are. And so that's my principal thing. In terms of data, there's position data is, not what you want. What you really want is the ticket that somebody is about to enter their order in. But what you get is anything from, foreign government data, which is 2 months delayed on the tick data, or, the best you can get is mutual fund and ETF data in terms of publishing their NAV the next day and their AUM the next day to notice if there's inflows and outflows. But all the data is, lagged by more than you'd want, and not as frequent as you'd want, by and large. So in order to use it effectively, you really have to build cohorts, back test how those cohorts behave, triangulate the data you see with them, and then also try to understand why they move, so that you can have something that can predict what ticket they will write. And that depends on the types of tickets they have written.
This brings me to a discussion on your so-called Framework 101 of Damped Spring Macro. You tweeted it earlier this year, pointing to 4 different factors or indicators that you watch on a weekly or daily basis to assess the upcoming investment environment. So let's try and have a look at these 4 factors one by one and get your thinking on how to build a thesis and a structured narrative around each of those factors. The first one you mentioned is growth expectations and their changes. What do you mean by that, and how do you assess it?
Right. So I think what's important, because there are great firms, this is what I believe is these 4 pillars are table stakes to trade macro. I don't think it's, in my opinion, very innovative. It's just literally the minimum you can use to trade macro. So let's just start it from there. And I just want to keep it simple for people. So growth expectations drive assets differently. When growth expectations rise, stocks go up and bonds go down. Other assets behave in different ways. And I can go through that. But just keeping it with stocks and bonds, when growth expectations rise, stocks go up and bonds go down. So how do you measure growth expectations? Well, that's tricky. One of the ways is measuring consensus, what analyst consensus is. And you can see how that changes. And the change in that consensus can also be a predictor. In addition, you can try to have your own version. You can use GDP Now, which has its own flaws and strengths, or you can build a leading indicator. Those are, paths that I take. And then it's what's priced in. And so then you're looking at asset markets and comparing those shifts. And some assets are more useful for growth expectations than others. There's lots of people that happen to look at the gold-copper ratio as an indicator for growth. That's perfectly reasonable. Think about what I do is I try to think about everything every market price that could be an indicator of growth, and then see how well it has been an indicator of growth, and then incorporate it as one of my signals, while simultaneously, it's circular, right? If you're using market prices to anticipate changes in expectations of growth, then you're going to try to buy the same market based on that. You may, you have a circular problem. So you have to triangulate it with non-market data. And so I think that's basically table stakes around growth. And the same thing applies to inflation if you want to go there. In inflationary environments, bonds go down, and stocks are an interesting asset. Sometimes they are pro-inflation and sometimes they are anti-inflation. And in local currency terms, they're often very strongly correlated with hyperinflation. They go up a lot when there's hyperinflation. but down at the level where we're at, where we're not at a hyperinflation environment, inflation impacts, changes in inflation expectations have to be more carefully drawn, which is it a top line inflation, which is beneficial to nominal top line sales, or is it a cost inflation like wages or input costs? Because the pace of those two inflationary forces has a big impact on margins. And so, the same idea of tracking inflation expectations with leading indicators, surveys, analyst surveys, and market expectations triangulated into a signal, then has to be compared to the asset and its delta to that signal. And in equities case, even deeper down, which of these two things are moving faster. So that's my approach with inflation.
Andy, let me throw a thesis at you in relation to inflation expectations and the distinction between top line and cost inflation. I tend to think that what we saw in late 2021, when equities were still rallying, was top line inflation. The initial move in inflation drove the top line, while what we see right now is more cost-based inflation, a move towards higher wages, cost pressures from energy, etc. That ratio has shifted firmly towards the cost side pressure from being a top line driven inflation pressure. Is that something that you share as a view, as a narrative into next year, that this could be sort of a change of scenery for the type of inflation that equities are faced with?
I have defined in a number of my writings, with quite a lot of criticism by smart people, not trolls, smart people, this concept of a equity sweet spot, where margins can expand because of nominal top line growing faster than nominal cost. And we've seen nominal wages we've seen real wages lag. We haven't seen real wage gains relative to growth. So that sweet spot certainly is in existence now, and I do agree it's likely to end. But it is an interesting issue in that it'll depend on how much any economic slowdown affects capital relative to workers. And are workers willing to, you're going to have to fire workers to get some of your wage leverage back, but there's quite a demand for workers in certain industries. So my sense is we're nearing the end of that inflationary sweet spot for equities, but I don't think it has ended yet. I think it's just very close to nearing its end.
And I guess the earnings from Q2 and Q3 would support you in that view that the sweet spot it's not yet ended, but let's see for Q4 and Q1. Yeah.
And there's been some earnings revisions. There is 2023 consensus earnings are coming down, but they're still high, which would indicate continued, Goldman went to 225, which I think is, for a big institution near the lows. Versus 235. But, you'll start to see it in the earnings consensus and also sort of in the guidance. But, my sense is we're very near the end of the, that sweet spot for equity margins. Many people are quite a bit more bearish than I am and don't recognize the sweet spot at all. But it's there. It's just a question of how long it'll last.
That moves us to the third pillar of your macro framework, the changes in the so-called risk premiums. So the added premium on top of the risk-free rate for holding cash that you need as an investor to be tempted to buy into assets. So we've already touched upon this topic, but how do you exactly measure risk premium across assets? And is there ways to sort of gauge where risk premiums will move over time?
Well, I mean, I certainly try. And the way I try is I count things. I count, and the good news is it's interesting. Prior to the QE era, and certainly completely dominated by the last 2 years, it didn't really matter about what the major drivers, the minor drivers of risk premium were. It's all been about fiscal and monetary drivers. They've just dwarfed every other driver. And so, for the home gamer out there, it's looking at the Fed's balance sheet. It's combination of runoff, the RRP balance, the Treasury's TGA balance, bank reserves, all of those things, and tracking them, and then comparing that to issuance and what that would put in the private sector gets you a long way there in this environment. But down a level, you always want to just figure out each economic player and what their status is regarding investing. Are they flush with cash looking to invest, or are they looking for cash trying to pay off debt? And that driver for each player in the economy is what I try to track, at a detailed level. And as I said, the good news is for people at home is you don't really need to track the usual suspects, because the major player, the elephants, are driving everything.
And I guess for now, we have at least decent clarity on the direction of the Fed balance sheet for the time being. We obviously don't know whether they will return to a QE era if the recession hits next year. But for now, we know that dollars will be withdrawn month after month, creating this monetary tightness alongside this increased bond issuance that you mentioned. That brings me to the fourth pillar, the flow assessment.
Right.
This is obviously one of the key reasons why it's always interesting to be on a trading floor, right? I've worked at a trading floor for more than a decade, and you obviously had a sense of the flow when working at such a place. But how do you assess the flow if you're not at the epicenter of flows? Andy, how do you measure it from the outside?
Yeah, I mean, it's a matter of horizon at some level. When you're measuring flows at a sell side as a market maker throughout my career, I measured flows based on orders that were actually coming onto my desk, and you could measure that. You could know whether the market was for sale or the market was to buy, and you could get ahead of that, front run it, frankly. That is, not my edge. For that matter, I think it's very difficult for anybody to compete on a day-to-day basis with Ken Griffin or Jim Simons or any of the people that are have high frequency computer algorithms, and the transaction costs for anybody sitting as an investor are just too high to try to trade short-term flow. So you look for opportunities where major positionings that takes many days to unwind is about to move. And so to do that, you actually, I mentioned the various data sources you have to look at, and who's positioned what and how they've moved over time and what tends to cause them to move. And that's what I think about when I think about flow. And I would say that periodically, there still are, insane, inelastic flows that hit markets that move price in a way that is impossible to front run. I wrote about the Tesla addition to the S&P, and that was a 20% move in one day, because simply there was no seller that was willing to sell to the index funds. And the same thing applies on occasion in the option space with concentrated positioning. But that's, sort of very narrow stuff. The big stuff is determining who owns what condition they are in as an investor. Are they up a ton and experiencing a drawdown? And how do they behave? Is that different than they behave when they're down a ton and experiencing a drawdown? And I think logic and data would show that they behave differently. And so you're tracking all the variables that each, relatively, the important thing is, one hedge fund buying from another hedge fund is not flow that you're going to care about. What you want to know is when all hedge funds or all insurance companies or all pension funds are doing the same trade, because that's when you have the biggest market impact. So I generally, look for cohorts that behave the same when when it's important to know when they behave the same. And then, have whatever data I can to predict how they'll behave. And then you test that through 25, 30 years of these cohorts behaving based on history. And that's how you make your flow bets. And so that's what I do.
So the final exercise that I would like to take you through in today's interview, Andy, is your best spot assessment of these four pillars. So if we start with the first pillar, the growth expectations and their changes, the best assessment today, do they make you interested in buying or selling assets overall?
So the growth pillar has different effects on different assets. Mm-hmm. It makes me want to, my expectation for growth is that growth is very strong and going to weaken. And that is broadly priced in overpricing equities and underpricing bonds. So that particular outlook is pro what I am now calling the great convergence, which is the return of outperformance of bonds versus stock after a year of just historically bad underperformance of bonds versus stock. So that growth thing is definitely pro bonds, anti-stock, and neutral assets in general.
And what about inflation?
So inflation, the problem I have with being pro bonds based on what is falling inflation is that you have to believe that inflation expectations as measured by market prices of break-evens have a lot of downside. They're currently in the low twos, and the target is 2. And so it's not clear to me there's a lot of juice in bonds, but there's some to consistent with a long-term downtrend of inflation. But I just don't think it's a strong enough driver to make a bet on right now. And so I would say my inflation driver is not a strong, does not have a strong delta to any assets right now.
And if we look at risk premiums, I think that's one of the interesting ones right now at the current juncture.
Yeah. So I believe risk premiums have a tremendous headwind of U.S. tightening and global and West European tightening. And we've seen a tremendous amount of releveraging, which is going to run its course and then often follow with deleveraging again. I think that risk premiums are almost certainly not going to go down and have quite a bit of upside to them, which means downside for assets. So by and large, I'm fairly bearish on assets via that risk premium channel.
And ultimately, the spot assessment of the positioning and flow picture, you briefly touched upon it, but it seems as if it backs up this bearish asset story.
So what I'm looking for right now is I think bonds have made a tremendous move. And obviously, it's partly been on economic conditions, but more likely it's been based on flow. And I think there's been a mass short covering. It's not obvious in the data yet, but one of the things I'm looking for is there are a number of public tracking CTAs and some public CTAs, and that seems to be where most of the pain is being felt. I'd like to see something like DBMF or CTA pause, not continue to go down, but just stabilize in terms of their returns when markets are moving. So let's say bonds continue to rally. I'd like to see their position, those CTAs their performance be neutral. Right now, when bonds have rallied, their performance have fallen. I'd also like to see their performance be neutral if bonds were to start falling, because that particular thing would give me a sense that they had gone flat, their bond position, and didn't have anything anymore. So they didn't have any exposure to bond market. And to me, that would mean a fairly likely end to the short covering. That's just a simple thing, one I'm paying attention to, but that's just a simple indicator, which, I'm looking for the short covering in bonds to end. These guys were short. You can tell if they've covered based on their their spot performance versus spot changes in bonds. When they stop being inversely correlated to bonds, they must have covered.
Andy, what a great interview. The whole reason why Releveraging was invented was to make the investor audience wiser on portfolio construction and how to assess various macro trends when making investment decisions. And you've certainly made me wiser today, and probably also most of the audience out there. So I want to thank you so much on behalf of the Releveraging community for joining us.
Thank you, Andreas. It was a lot of fun. I really enjoyed it. Hope I could help.
Thank you. It was great to finally get the chance to spend 45 minutes together with Andy to understand his thought process and to understand his methods to construct the portfolio. It's very easy to hear that he's got tons of experience in the portfolio construction industry. And if we look at his 4 pillars of portfolio construction in a changing macro environment, the first pillar on growth expectations currently point towards negative developments in the stock market. The recession is looming, and usually at this juncture of the business cycle, the cost pressure outpaces the inflation seen in the top line. So it should be negative for earnings into next year. But at the same time, this could be, from a growth perspective, a decently positive scenario for bonds, at least if the recession is strong enough to pull down inflation pressures that we see right now. But when it comes to the inflation pillar of the portfolio construction method, it seems as if Andy is more neutral when it comes to his positioning, mainly as a consequence of inflation expectations already being low next year and a slowdown in inflation already being in the price of forward pricing of bonds and inflation swaps. The third pillar on risk premiums, so the extra premium needed to take on risk in assets relative to holding risk-free cash. And it's very clear that this is the most important component of his methodology right now, due to what's going on with the Fed balance sheet. The quantitative tightening process is important when it comes to measuring monetary tightness, broadly speaking, in the US community and the society. And right now, the tightness is actually increasing by the month due to quantitative tightening paired with increasing bond issuance. So the amount of issuance needed to be swallowed by the private sector is growing. And this is usually something that filters through to a higher risk premium, which is overall a negative story for assets, so both bonds and equities. And finally, when we watch the flow and positioning today, Andy tells us to be aware of the trends seen from hedge funds in the bond space right now. We've seen a positive repricing of bonds due to lower inflation in the last report, but Andy finds that the price action is exaggerated by short covering of leveraged funds. And when that short covering is over, it's probably a good time to find new opportunities to short the equity market as a consequence of higher real interest rates when the short covering is over. So overall, the methodology points towards shorting assets, broadly speaking, but from a relative perspective, bonds may overweigh stocks and performance. Thank you for watching.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.